Well, it looks like the median home price has continued to fall. We are officially down 3.3% year on year, bringing the median home price to just over 400,000. This is actually the lowest year on year drop that we've seen since 2012. And what I want to mention here is that it is a bifurcated market. Some areas are doing well while others are doing not so well right now. And a lot of these areas that are actually leading the price declines here are going to be pandemic boom towns, tech hubs, where we saw a lot of migration in, as well as very pricey Bay Area markets where home prices got wildly disconnected from local wages. In fact, areas like Boise, Idaho, where we saw a ton of migration from California, is leading the charge on year-over-year price declines. They're currently sitting at 15.4%. And then other metros like Austin, Texas, Sacramento, San Jose, and Oakland were hovering in and around 10% declines year on year. There are other areas throughout the country that are holding up much better, and we'll talk about those here in just a second. But as many of you know, nationwide, we are seeing a reduction in transactions. So we see pending home sales are down here 26.6% year on year on a seasonally adjusted basis. This is actually the lowest level that we've seen in a very long time, besides the onset of the pandemic, which happened in March and April of 2020. And not to pick on Boise, Idaho, but they actually saw the largest decline in pending home sales year over year, with a drop of 78.8%. So you could imagine the home buyer demand has really just fallen off a cliff in Boise, Idaho. And let's take a look at one small anecdote from a Redfin agent. She says that she was consistently busy in the fall, but things got really quiet in March after the collapse of Silicon Valley Bank. And that killed the buyer momentum that had been building up and brought us right back to where we were last year when mortgage rates shot up. There's this fear that everything will crash. They're seeing bank failures. We're dealing with inflation and recession fears, and some people are wondering if they should pull all of their money out of the bank and park it in a safe rather than spend it on a new home. And she goes on to say that the irony is that it's actually a pretty good time to purchase out there in Boise, because this drop off in home buyer demand actually means that home prices are falling and sellers are having to provide concessions in order to close these deals. While I agree with most of what she's saying here regarding people being fearful and pulling their money out of the bank, I think there's also people in the other camp or investors who have a substantial cash position where they're saying, you know what, I don't necessarily want to keep my money in the bank. I want to put it in a hard asset or a real asset that can be productive. They're going out and potentially overpaying for property because they'd rather pull the money out of the bank, park it in a physical asset that will be productive over long periods of time and generate rental income. Now, as I mentioned earlier, we're definitely dealing with a bifurcated market, and the markets that did not heat up as much in these recent years are actually holding up pretty well. According to Redfin, home prices actually rose over 10% year on year in markets like Milwaukee, El Paso, Texas, Omaha, Nebraska, Camden, New Jersey, and Knoxville, Tennessee. Those were the biggest home price gains that we saw throughout the country, while at a national level, we're seeing home prices decline, and in some of these high-flying markets like Austin, Texas, and Boise, Idaho, we're seeing large price declines year on year. On top of prices coming down in some of these markets and a massive reduction in transactions, elevated mortgage rates are prompting both buyers and sellers to stay put right now. New listings actually fell 23.3% year on year. This is the lowest level on record aside from the onset of the pandemic. And what it comes down to is there is this standoff between buyers and sellers right now. Sellers are not willing to trade their 3% interest rate for a 6 or 7% interest rate. And buyers are simply priced out of the market due to affordability. The volatility in the mortgage market continues. This is the 10-year treasury yield, which mortgages tend to track rather closely. It's a 30-day chart, and you can see these wild fluctuations. Believe it or not, these are actually really large moves for the 10-year treasury yield. We saw the 10-year treasury yield go from over 3.5% down to 3.3% nearly a couple times throughout the last 30 days. And then when you take a look at this chart, you can see that mortgage lenders are starting to price in more risk and volatility in the markets. So what we have here in red is going to be your 10-year treasury yield, and in blue, this is going to be your average 30-year fixed rate mortgage. The spread is generally anywhere from 1.5% to 2% depending on the market conditions. When lenders perceive there is less risk in the market, you may only see the spread somewhere between 1 and 1.5%. But as the market starts to price in more risk, you can see the gap widens. So back here in 2020, you see that the spread was right around 2.5%. And that's roughly where we are sitting today. So in other words, mortgage lenders are acknowledging that there is more risk and more volatility in the market. And that's bringing us to where we are today with the average 30-year fixed rate mortgage on a conventional loan coming in at 6.75%. This is up nearly a half a percentage point here in the last week, which, as I mentioned, this is a pretty big move and it's something we're going to have to pay a lot closer attention to because markets are so hyper focused on where the interest rates are right now. If we see these rates continue to go up to, let's say, 7% or higher, it's going to sideline more and more buyers unless prices actually start to come down to make the affordability factor make a little bit more sense. All right, that is going to wrap it up for today's video. If you found the information useful, please consider hitting that like button and subscribing for more weekly housing market content. I would be so grateful. Thank you so much. We'll see you on the next video. Take care.